Have you noticed that every few years your international trips seem to get more expensive? Or your imported purchase wish list for an iPhone or a MacBook just seems impossible to achieve? Well, that's because rupee seems to get weaker compared to dollar every year. In the early 2000s, $1 was roughly 40 rupees. Today, it's far higher and many people feel the rupee is constantly falling. In this video, let's break down why the rupee tends to depreciate against the dollar over time, what's structural differences between these two currencies, what's temporary, and what it really means for you and your purchasing power. Stay till the end because in the last section, I'll explain when a rupee is actually falling normally compared to a dollar and when it is a genuine red flag to be concerned about. So, first a quick recap of what rupee depreciation really means. When we say rupee is depreciating against the dollar, we simply mean you need more rupees to buy $1 than before. So, like I mentioned earlier, in the early 2000s, you needed 40 rupees to buy $1. Currently, you need somewhere in the range of 89 to 90 rupees to buy $1. If the exchange rate goes from 40 to 90, the rupee has weakened. But if it goes from 90 back down to 80, the rupee has strengthened. This exchange rate is not fixed by the government on a daily basis. It is largely decided in the foreign exchange currency markets, where banks, companies, investors, and speculators are constantly buying and selling rupees and dollars. And like any market, the price moves based on demand and supply. If more people want dollars related to rupees, the dollar becomes more expensive in terms of rupees. Now, let's understand the different reasons why the rupee depreciates against the dollar. Reason number one is inflation, especially India's inflation versus US inflation over longer periods of time. If prices in India rise faster than in US year after year, the rupee tends to lose value relative to dollar over time. Imagine a simple example. If India's inflation ranges in the range of let's say 5 to 6% every year and US inflation is in the range of 2 to 3 or 3 to 4%, then goods and services in India becomes relatively more expensive every year compared to those in the US, much faster. To keep the competitiveness roughly in balance, the currency of a higher inflation country usually depreciates gradually against the currency of the lower inflation country. This is linked to the concept of purchasing power parity. In theory, if the same basket of goods keep becoming more expensive in rupees than in dollars, the exchange rate slowly adjusts to that of dollar, buys more rupees. So a part of rupee's long-term depreciation is simply the math of India's inflation being high compared to the US inflation. The second reason is trade deficit and dollar demand. So let's understand India's persistent trade deficit and stronger dollar demand that comes with that deficit. India imports more goods and services than it exports, especially items like crude oil, gold, electronics, and certain capital goods. To pay for these imports, India and Indian companies have to buy dollars because most global trade happens in terms of dollars. If on an average every year Indian people need more dollars to pay for import than it earns from exports, that creates continuous demand for dollars. When demand for something is structurally high compared to its supply, its prices tend to increase and stay strong over a period of time. This doesn't mean India is weak. Many growing economies import capital goods, technology, and energy to support their growing demand and growing needs. But it does mean that all else equal, the rupee faces downward pressure because the system constantly needs dollars. Unless this trade deficit is offset by other inflows like remittances from people staying abroad to India, service exports, or foreign investments, the exchange rate tends to move in a way that makes imports relatively costlier and exports relatively cheaper. That adjustment often shows up as a weaker rupee over time. Now let's dive down into the reason number 3, which is capital flows and risk sentiments. So, foreign investors put money into Indian stocks and bonds when they feel optimistic about India's growth, its returns, and stability. When those flows come in, they must buy rupees, which can temporarily strengthen the currency. But in terms of global fear, such as financial crisis, geopolitical tensions, or big market corrections, these investors often pull money out of the emerging markets like India and move into safe assets like US Treasury bonds. To exit, they sell rupees and buy dollars, which puts downward pressure on the rupee. So you'll often see sharp rupee movements during global events that may have little to do with India's domestic fundamentals. This is why there can be sudden bouts of volatility and the rupee might move a lot in a short period when foreign investors rush to exit or pile back in. Now let's dive into reason number 4, which is the US interest rates and the strong dollar cycles. When the US Federal Reserve Bank hikes its interest rates aggressively, dollar dominated assets become more attractive. Investors around the world then prefer to hold more dollars and US bonds because they now pay higher interest rates. This can trigger a strong dollar phase where many currencies and not just rupee weaken against the dollar. Even if India's own fundamentals are decent, higher US interest rates can pull money away from emerging markets around the globe and into dollar. In this period, you'll often hear that rupee is falling, but in reality, all currencies around the world may be falling against the dollar at the same time, because dollar itself is strengthening across globally. Now let's dive into an important question: is rupee depreciation always bad? A slow, gradual depreciation, roughly in line with the inflation gap, can actually be a part of a normal adjustment process. It helps Indian exports be competitive in the global market and reflect that India's reality and India's prices tend to be rising faster than US prices. The bigger concern is not gentle but a long term weakening or a sudden sharp in terms of rupee compared to dollar. This has happened in the last 1 year when rupee has suddenly dropped 6% compared to dollar. This is a very sharp drop in a very short time. That often signals stress. Maybe foreign investors are exiting rapidly from Indian domestic market, or there's a global shock, or markets are worried about policy or the current tariff rates or deficits that India has. So when you hear headlines about the rupee hitting record low, it's useful to ask the question, is this just the continuation of the long term trend that we have been seeing right from the 1990s and 2000, or is it something unusual and disorderly that's happening in the markets right now? Finally, what all this means for an Indian saver, investor, or an everyday consumer. A weaker rupee makes imported items like foreign education, foreign travel, gadgets, and crude linked domestic products more expensive in rupees. On the other hand, it can support export oriented sectors like IT services and certain manufacturing segments that earn in terms of dollars. For your personal finances, it's a reminder to diversify. For example, by having global investments or global assets directly or indirectly in your portfolio. So, wealth isn't entirely tied to one currency. If you found this breakdown really helpful, do hit this likes button and share it with someone who keeps asking, why is this rupee always falling against dollar? And subscribe to my channel Finesse for more such simple explanations on money, currency, and economy.